The radio in the kitchen was tuned to the USDA farm report, and the word declaration came through the static at 6:47 in the morning. Not a forecast. A federal drought declaration. Kearney County, Nebraska. Official. Filed. Which meant that somewhere in a filing cabinet or a desk drawer or a banker's folder, that word was going to matter to someone. And not just in the way politicians mean it when they want to look useful. Dale Hester heard it from the kitchen table. His coffee was already cold. His son Gary had been up since 5, and the phone call Gary made that morning, the one to the insurance broker in Grand Island, had already been made 2 months earlier. The policy was gone. The premium had looked like $1,400 that could go somewhere else. And in April of 1985, $1,400 was not a small number. This is a story about that gap. 2 months, 1 canceled policy, 1 forgotten rider, and a drought that didn't care about either. The farm crisis of the mid-1980s did not arrive like a storm. It arrived like a slow leak, the kind you notice only after the floor has warped. Interest rates that had been pushed into the high teens to break inflation were now coming down. But the debt farmers had taken on at those rates didn't come down with them. Land values that had climbed through the 1970s reversed sharply after 1981. A farmer who had borrowed $300,000 against land appraised at $400,000 was now sitting on collateral worth $220,000. And a bank that was starting to ask hard questions. Gary Hester was 34 years old in 1985. He had taken over day-to-day operation of the farm in 1981 after his father Dale's back surgery. The transition was informal, the kind farms run on. No partnership agreement, no formal transfer. Just a gradual shift in who made the calls and whose name went on the operating loan each spring. Gary was the one talking to the banker now. Dale still walked the fields. Dale still kept the files. The Hesters ran a grain operation. Corn and soybeans, about 1,100 acres across 3 parcels in Kearney County. Not large by corporate standards, but large enough that every input cost, seed, fertilizer, fuel, crop insurance, added up to numbers that made a person sit down with a legal pad and a calculator at the kitchen table on February nights and look for places to cut. Gary had been doing exactly that in February and March of 1985. Crop insurance, in the mid-1980s, was a different product than it became after the Federal Crop Insurance Reform Act of 1994. The coverage was less comprehensive, the premium subsidies smaller, and the uptake among farmers was genuinely uneven. A lot of farmers saw it the way Gary did, as a premium paid against a loss that might never happen. You're buying protection you hope to never use. And when cash is tight, protection you're not using feels like the first thing to cut. The premium on the Hester's primary multi-peril crop insurance policy was $1,380 for the 1985 season. It covered yield losses from a range of causes: hail, excess moisture, disease, and drought, among others, down to a guaranteed yield floor of about 65% of their proven yield history. If the harvest came in below that floor, the policy paid the difference at a set price per bushel. Gary looked at that $1,380 in March and made a decision that was not irrational. The farm had not filed a crop insurance claim in 11 years. The premium was real money every spring. The operating loan was already stretched, the bank was already nervous, and he needed to show some reduction in projected expenses. He called the broker, gave notice, and the policy was canceled before the planting deadline. Clean. Documented. One less thing. He did not tell his father for 2 weeks. When he did tell him, Dale didn't argue the way Gary expected. He said, "You pull the base policy?" Gary said yes. Dale was quiet for a moment, then said, "You checked the riders?" Gary said. "What riders?" And Dale said he'd looked through the files. Here is where the story turns on a detail that most people outside agricultural insurance would never think to ask about. A rider, sometimes called an endorsement, is a separate addendum to an insurance policy. It modifies or extends the base coverage in some specific way. In crop insurance, riders could be purchased for specific perils, specific fields, or specific trigger conditions. They were often written separately from the main policy, sometimes with different renewal structures, sometimes attached to the policy number of a prior year's coverage that had since lapsed or been replaced by a newer policy. Dale had purchased a drought-specific rider in 1979. He had attached it to that year's multi-peril policy, which was issued through the Federal Crop Insurance Corporation, the predecessor to what later became the Risk Management Agency. The rider was narrow in its trigger. It paid out based on a county-level drought declaration from the USDA, confirmed by the local FSA office, with a payment formula tied to a yield loss estimate for the covered acres. When Dale replaced the 1979 base policy with a new policy in 1981, the rider was not automatically transferred. But it was also not canceled. It existed in a kind of administrative limbo, attached to a lapsed policy number, but still listed as active in the federal crop insurance ledger because no formal cancellation notice had ever been filed for that specific endorsement. Dale found this in the files in late May, sitting at the kitchen table while Gary was in the field. He pulled out a manila folder with 1979 written in pencil on the tab and found the rider document, 2 pages, dense print, government formatting. He read it twice. Then he called the broker. The broker's name was Ed Paulson, and he had been handling agricultural insurance in the region for 20 years. Dale read him the policy number and the endorsement number. Ed put him on hold for 10 minutes. When he came back, he said he'd need to verify with the FCIC, but based on what Dale was reading to him, that rider might still be on the books. Might is a word that farmers learn to distrust. But it was enough to make Dale keep the folder. The summer of 1985 in south-central Nebraska was dry in the specific way that agricultural dry means. Not desert conditions, not dramatic dust storms, but a persistent rainfall deficit during critical crop development windows. May was short on moisture, June worse. July was the month that cost people. Corn requires consistent moisture through the tasseling and silking stages, which fall in July for most of the region. A dry July is not just an inconvenience. It's a yield event. Kernels don't fill. Ear development stalls. You end up with plants that look like they're producing something and produce significantly less than they should. By mid-July, the conversations at the grain elevator, at the implement dealer, at the coffee shop in Minden, were all running the same direction. Everyone was estimating their own losses. Most people were doing it with some crop insurance in place. Gary was doing it with none. He had known since late June that the season was going to be short. He'd walked the fields enough to see it. What he hadn't done was think about the insurance, because he'd made that decision in March and it was final, and there was no point revisiting it. The operating loan was $185,000. The bank had covenanted a minimum harvest value as a condition of the loan. If the harvest came in significantly below projections, the bank was going to have a conversation Gary did not want to have. At the end of July, the USDA issued a formal drought declaration for Kearney County. It came through the regional FSA office, was confirmed by the state agricultural department, and was broadcast on the farm radio reports and printed in the agricultural extension notices. This was not a political gesture. This was a triggering mechanism. A specific legal designation that had implications for federal disaster programs, emergency loan eligibility, and in certain cases, insurance riders. Dale heard it on the radio. Gary heard it in the field, from the same broadcast, standing next to a pickup truck with the door open and the volume up. Gary's first thought was that it meant nothing for them, because they had no coverage. Dale's first thought was the folder. He called Ed Paulson again that afternoon. This time Ed had already done some checking. The endorsement number Dale had given him matched an active record in the FCIC ledger. It had never been canceled because no one had ever filed the cancellation paperwork. The base policy it had been attached to was gone, but the rider itself had a separate administrative existence. It had been issued under a different instrument than the base policy, and the FCIC's records showed it as independently outstanding. "Now, Dale," Ed said, "I want to be careful here. This is unusual. The base policy is years gone. The question is whether the rider has independent standing without the base policy to anchor it. That's a legal and administrative question, not just an insurance question. I need to get a formal opinion from the FCIC." Dale said, "You get it." Gary was not there for this conversation. He found out about it that evening when Dale put the folder on the kitchen table and explained what he'd found. Gary's first reaction was skepticism, which was reasonable. A rider from 1979 attached to a policy that had been replaced twice since then. The odds that it was still valid seemed low. "How does a rider stay active on a policy that doesn't exist anymore?" Gary asked. Dale said, "That's what Ed is finding out." The answer, when it came back from the FCIC 3 days later, was complicated in the way government answers usually are. But the core of it was this: the rider had been issued as a separate endorsement instrument, not as a subclause of the base policy. The FCIC's administrative code at the time treated such instruments as independently renewable unless explicitly canceled. Because no cancellation notice had ever been filed, not in 1981 when the base policy changed, not in any subsequent year, the endorsement had continued to renew automatically, with the annual premium assessed and charged to a dormant account that Dale had set up in 1979 and apparently never closed. This last part was the part Gary hadn't known. The premium on the Drought rider was $47 per year. It had been charged to an account Dale kept separate from the operating funds, an old Farm Bureau account that had a small balance Dale occasionally added to without much discussion. It was not a large amount. It was the kind of amount that disappears into the background noise of farm finances. But it was being paid every year, and that made the coverage legitimate. The rider was active. The county drought declaration had been issued. The coverage trigger had been met. Ed Paulson walked them through the payment formula. The rider covered 900 acres of the farm's corn ground, the acreage that had been enrolled in the original 1979 policy. The payout formula was tied to a county yield loss estimate issued by the local FSA office after crop surveys, multiplied by a per-bushel indemnity rate set at the time of the rider's original issuance, and adjusted annually by a factor Dale had not tracked closely, but which Ed had the records for. The preliminary estimate, based on the FSA county yield loss numbers and the covered acres, put the potential payout between $38,000 and $52,000. Gary sat with that number for a long time. The bank's involvement added a layer that made the whole situation more complicated before it got cleaner. When the drought declaration came through, the loan officer at the bank, a man named Strickland, who had been handling the Hester account for 4 years, sent a written notice requesting confirmation of crop insurance coverage for the 1985 season. This was standard practice. Banks with agricultural operating loans needed to know whether their collateral was protected. If the crop was uninsured and the harvest came in short, The bank's position deteriorated in direct proportion. Gary's honest answer to Strickland's inquiry was that the primary policy had been canceled. He called the bank and said exactly that. Strickland's response was measured but clear. If the harvest value came in below the loan covenant threshold, the bank would need to discuss restructuring. What that meant in practice in 1985 was a reduction in the operating line for the following year, which meant less ability to plant a full crop the following spring, which meant a smaller revenue base to service the debt, which was the first step in a downward cycle that had already ended in foreclosure for several farms in the county. Gary did not mention the rider during that conversation, because at that moment the rider's validity had not yet been confirmed. Mentioning a possibly active insurance policy from 1979 to a bank loan officer before you had written confirmation from the insurer was not something Gary was prepared to do. It would have sounded like wishful thinking. He had 2 weeks of uncertainty. The FCIC was reviewing the endorsement. Ed Paulson was coordinating with the regional office. The FSA was conducting its county yield surveys. Gary was harvesting what the fields produced and watching the yield monitor numbers in real time and doing the math in his head on every pass. The corn came in at 74 bushels per acre on the covered ground against a county average yield history of around 118. That was a 37% shortfall in a county that had just received a formal drought declaration on acreage covered by a drought rider that, pending final confirmation, appeared to be active. The FCIC issued its written confirmation of coverage status in late September. The rider was valid. The drought declaration satisfied the trigger. The payout eligibility was confirmed at $44,200, with final calculation pending the formal FSA yield loss certification for the county. Ed Paulson called Gary with the news. Gary was in the shop, working on a planter bearing that needed to be replaced before winter. He sat down on a grain auger when Ed finished talking, not because he was overwhelmed, but because he needed to think through exactly what this meant for the operating loan conversation with the bank. It meant the farm was not exposed the way Strickland had understood it to be. It meant the operating covenant could be met. It meant the conversation about restructuring did not have to happen, or at least did not have to happen in the way Gary had been dreading. He called the bank the next morning with the FCIC confirmation letter in hand and walked Strickland through exactly what had happened: the policy, the rider, the dormant premium account, the drought declaration trigger, the confirmed payout. Strickland asked for a copy of the FCIC letter and the endorsement document. Gary sent them. The bank's position shifted from concern to something closer to neutral. The payout, once it cleared, which took until December, would be credited against the operating loan balance, bringing it to a level the farm could service through the following year's operating cycle. The farm did not thrive in 1985. There was no version of that year that ended with thriving. But it remained functional. The operating line stayed open. The planting loan for 1986 was approved, smaller than 1985, but approved. The land didn't go to sheriff's auction. The cycle continued. What actually happened at the kitchen table after that, between Gary and Dale, was not a dramatic reckoning. There was no speech about respecting the old man's wisdom or understanding the value of protection. Farmers don't generally have those conversations. What Dale said the evening after Gary called the bank was something like, "You know the rider wasn't my intention to leave active. I just never got around to filing the cancellation." Gary said he understood that. Dale said, "But I also never got around to it because $47 felt like nothing to cancel." Gary said that made sense, and that was mostly it. The more interesting conversation happened a few days later, when Gary sat down with the policy documents and tried to understand, structurally, what had happened. Not emotionally, structurally. A crop insurance policy is a hedge, not an investment. You're not buying it hoping to collect. You're buying it to transfer the risk of a yield shortfall from your own balance sheet to an insurer's. The premium is the cost of that transfer. When you cancel the policy, you're not saving money in any absolute sense. You're taking back onto your own balance sheet a risk that the insurer was holding. The $1,380 premium Gary had canceled was not $1,380 in profit. It was $1,380 that had been paying someone else to carry a risk Gary then decided to carry himself. The problem with carrying risk yourself is that it doesn't feel like carrying anything until the risk materializes. Cash feels urgent. Risk feels abstract. In March of 1985, the drought that would come in July was not visible. The premium was. So the premium got cut, and the risk got absorbed without anyone consciously choosing to absorb it. This is the decision most farm operations in financial trouble made in the mid-1980s. It wasn't stupidity. It was a short time horizon applied to a long-duration risk. When you're worried about making the next loan payment, protecting against something that might happen in July feels less urgent than freeing up $1,380 right now. What the drought writer showed, inadvertently, and only because Dale had never gotten around to the paperwork, was how small the cost of protection can be relative to the exposure it covers. $47 a year had kept a $44,000 payout eligibility alive for 6 years without anyone paying serious attention to it. That's not a miracle. That's math. And it's the math that makes insurance a structural tool rather than a luxury expense. The banks understood this better than most farmers did, which is why loan covenants required proof of coverage. A bank with a $185,000 operating loan against a grain farm doesn't want to hold uninsured crop risk. If the farmer won't pay to transfer it, the bank absorbs it as credit exposure. And the bank will price that exposure into the loan terms, or simply decline to extend the credit. Insurance isn't just about what it pays out. It's about what it signals to the people who are deciding whether to lend you money to operate. Gary had not thought about it that way in March. He thought about it that way in October, sitting at a table with a FCIC letter and a call log and a legal pad with numbers on it. The distinction between cutting cost and cutting protection is not always visible in real time. Both decisions look like reductions on a spreadsheet. But one reduces what you're spending. The other increases what you're exposed to. In a year with no drought, no hail, no flood, they're indistinguishable. In a year with a federal disaster declaration, they're the difference between a farm that keeps operating and one that doesn't. That was the lesson of 1985 for the Hesters. Not that the father was wiser than the son. Dale had left that rider active by accident as much as intention, not that the system worked perfectly. It had taken weeks of administrative inquiry to confirm coverage that should have been straightforward to verify. Not that everything turned out fine. The farm was smaller in 1986 than it had been in 1984. The debt was still real. And the pressures that had made Gary cancel the policy in the first place had not disappeared. What it showed was that the structure had held in one specific place, on one specific document. Because no one had gotten around to filing a cancellation, that's not a system you can rely on. You can't count on administrative oversight saving you. But you can count on this. The coverage that stays in place is the coverage that can pay. And the coverage you cancel, regardless of how rational the reason, pays nothing at all. He thought he was cutting waste. The rider was quietly cutting risk. And for one drought year in one county in Nebraska, that $47 premium was the number that made the difference between a farm that went into 1986 standing and one that didn't. The drought declaration came off the radio at 6:47 in the morning, and by noon of the same day, Dale had the folder on the table. That's the part Gary didn't know, and couldn't have known. That his father had been keeping files the way some people keep tools. Not because he thought he'd need them, but because getting rid of them required a reason, and he'd never had one. In 1985, that was reason enough. If you're interested in real stories about how family farms navigated the hardest years in American agriculture, the decisions, the paperwork, the financial mechanics, and the people behind them, consider subscribing. These are the stories that don't make the history books, but made the difference at the kitchen table.